Why does understanding the various types of investing matter today in India? In an era where financial literacy is becoming increasingly crucial, it's vital to demystify common misconceptions and navigate through the diverse landscape of investment options available to us. Many Indians often believe that investing is only for the wealthy or those with a lot of free time. Another misconception is that investing is too complicated and requires expert knowledge. However, these views are far from the truth. Let's start by busting one of these myths. Investing doesn't necessarily require a large sum of money to begin. In fact, in cities like Mumbai, where the metro commute can be a daily grind, you might find people investing as little as 500 rupees through UPI transfers at their local kirana store. This is a common practice for those who don't have time to manage multiple accounts or prefer physical transactions. Now, let's move on to the full solution. The key to successful investing lies in understanding different asset classes and creating a diversified portfolio that suits your financial goals and risk tolerance. There are four main types of investments: stocks, bonds, mutual funds, and real estate. Each has its own set of benefits and risks. Firstly, stocks represent ownership in a company. They can provide high returns but come with higher volatility. Bonds, on the other hand, offer lower returns but are generally safer as they are debt instruments issued by companies or governments. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, making them accessible and less risky than individual stocks. Lastly, real estate can provide long-term capital appreciation and rental income. To implement this solution, start by assessing your financial goals and risk appetite. If you are looking for short-term gains, mutual funds might be the best choice as they offer liquidity and professional management. For a more hands-on approach with potential higher returns, consider stocks or real estate after thorough research and planning. Psychologically, people often avoid investing due to fear of loss or uncertainty. This is where the concept of diversification comes into play. By spreading your investments across different asset classes, you can mitigate risk. Think about it this way: if one area of your portfolio performs poorly, others might perform well, balancing out the losses. Moreover, setting realistic expectations and understanding that investing is a long-term game can help reduce anxiety. It's important to remember that while there are risks involved, over time, investments have historically provided better returns than savings accounts or keeping cash under your mattress. In conclusion, investing isn't just about making money, it's about securing your financial future. By breaking down the barriers and understanding the different types of investments available, you can take control of your finances and pave the way for a more secure tomorrow. Remember, every small step counts, whether you are transferring 500 rupees to invest in mutual funds or buying shares on your rent day. Embrace investing as part of your financial journey and watch your wealth grow over time. Now, let's talk about rent day. Rent day is like a mini budgeting exercise for many of us who live in shared spaces or apartments. It's that day when you check your bank balance and mentally prepare to pay the landlord or share the cost with roommates. This can be stressful if you are not on top of your finances, but it's also an opportunity to practice good money management skills. To make rent day less daunting, consider setting up automatic payments for your rent. This way, you won't have to worry about remembering the due date or scrambling to find enough cash. Plus, many banks and financial institutions offer tools like UPI, Unified Payments Interface, which allow you to pay bills directly from your phone, making the process quick and convenient. Learn more now, the Sarab Way.